during the year ended 30th April 2023, Timmis Enterprises received payment by check for disposal of motor vehicles for 14,000 and equipment for 2,500. Prepare the non-current asset disposal account for the year ended 30th April 2023. This is part D of the question 6. Okay, so let's prepare the disposal account. Okay, so the thing is, what is the cost? Okay, you are going to include on the debit side, and what have you will write what is its depreciation value and how much is the check value you have received. Okay, if it is the exceeds the cost, then you are going to make a profit. If it doesn't exceed, you are going to make it as a loss. So let's find out. So there are two things that's going to be disposed. One is a motor vehicle. So motor vehicle was disposed. Okay, and what was the cost of the motor vehicle? Motor vehicle's cost was 25,000. So they have given the value of the cost that was disposed, okay, in the schedule of assets. And the second one that was disposed was the equipment. So equipment, and it was like equipment, and the disposal we had calculated, its value was 5,000. So 5,000. This happened in the, okay, on the 30th April 2023. So we can write 30th April 2023, the date. Okay, and then because of that, okay, what was the accumulated depreciations also we can write. So the accumulated depreciations for the motor vehicle, okay, for the motor vehicle it was disposed, it had an accumulated depreciation of 10,000. So provision for the accumulated depreciation. This is provision for the motor vehicle. Okay, it is going to come from provision account. Okay, provision of accumulated depreciation for the motor vehicle, it's going to come from that, and it had the value of, okay, it had the value of 10,000. So let's write that at the value of 10,000. Okay, 10,000. And then you had the accumulated provision for equipment. Okay, so then accumulated provision for equipment was, so this was a disposal, it had an accumulated depreciation, okay, which was calculated, that was so that was 4,000. So that was 4,000. This was for the equipment, and this had 4,000. Okay, and towards this they received a check. Okay, they received 14,000 for motor vehicle. So bank, it was 14,000, and for the equipment they got 2,500. Okay, this disposal account is prepared together. Okay, this is a closing down account. The balance is not carried forward. You transfer it to the income statement and you close it off. So we have the motor vehicles. Okay, the motor vehicles. So let's add up here 25,000 plus 5,000. And on this side, if you add up, it is 10,000 plus 4,000 plus 24,000, 28,000 28 plus 2500, so that is 30,500. So you're getting 30,500, okay, which is more than the other side. So you're getting more here. So the amount exceeded is 500 pounds. So that will be transferred to the income statement as profit. It is like an income, okay, it is going to act as an income. Okay. So profit on sale, so the value is going to be 500 pounds. Okay, so that is the, this is disposal account. Next you have, the sales manager said that we depreciate same non-current assets using the straight line method, and some non-current assets using straight line method, and some using the reducing balance method. Why do we not just use the same method for all non-current assets? So suppose they are going to use the same method for all the non-current asset, it means they have been consistent across the same procedure of using the for depreciation for all non-current assets, and it would also become easier for somebody to calculate. Okay, that's the only advantage. So it will save time for business probably. But the negative point is, okay, the depreciation chart by Timmis Enterprises for the year may not reflect the reduction in the value of the non-current asset. Profits could get distorted because all non-current assets, they will depreciate in different manner based on the usage. That's why, for example, for the motor vehicles, they are applying reducing balance method, and for the equipment and fixtures which they are not using so much, they are using straight line method, which is correct to do so. In that way they will not distort the profit. Okay, so they will not overcharge depreciation in a single year. So in conclusion, they should be using straight line and both reducing balance method, and they should consistently apply for the non current asset based on the type